picture a split screen in your mind right now. Just a stark, brutal contrast.
Oh, this is a great visual.
Right. So on the left side, it is Tokyo. The year is 1989.
The absolute peak.
Exactly. The city is just drowning in neon. I mean, it is the center of the universe. The wealth is unimaginable. The energy feels completely invincible.
It was a machine that couldn't be stopped.
Or so they thought. Now, I want you to look at the right side of the screen.
Yeah.
The exact same city, but the neon is flickering.
Yeah.
The streets feel hollow. It is the stagnant, suffocating reality of the 3 decades that followed.
The last 30 years. I mean, it is basically the ultimate ghost story of modern economics.
It really is.
Yeah.
And, if you are listening to this deep dive, you probably think you know this story.
Everyone thinks they know it.
Right. You picture a frenzy of reckless greed. You picture a whole nation willingly losing its mind at the casino.
A massive speculative fever.
Exactly. You think it was mass hysteria. You think they were all just crazy. Well, you were wrong.
Completely wrong. The real horror of the Japanese bubble isn't that they lost their minds. Not at all.
What is it then?
The true cause of the crash hides in a fundamental misunderstanding of how the world actually works.
Okay, that is a massive claim.
It is, but we are diving into a huge stack of data today to prove it. Specifically, we are looking at this brilliant, highly contrarian paper by University of Michigan economist Robert Barsky.
And this isn't just theory, right?
No, it's hard data. It proves that what happened wasn't madness. It was something far more terrifying.
Wait, hold on. You are telling me it wasn't a casino?
Nope.
You are telling me a massive financial collapse was a machine operating exactly as programmed?
That is precisely what the data shows.
Yeah.
I mean, to understand the trap, we have to look at the smartest people in the room.
The professionals.
Right. We have to look at how they willingly, deliberately, and honestly, confidently walked right off a cliff.
Okay, so let's step into the illusion. I want everyone listening to imagine a giant chart of the Japanese stock index in 1989.
The Nikkei index.
Yes, the Nikkei. It is skyrocketing. I mean, it is blasting straight through the stratosphere. But right in the middle of that chart, I want you to stamp a massive blood-red question mark.
I love that. Because, we love to play Monday morning quarterback.
Oh, totally. We sit here today, decades later, and we laugh at the fools of 1989.
We assume they were just blinded by greed.
But here's the slap in the face. They didn't feel foolish.
Not even a little bit.
Let's look at the institutional surveys from the very peak of the market. We aren't talking about, retail day traders here.
No, we are talking about the giants, the professionals moving billions of dollars.
And the vast majority of them did not believe the market was in a bubble.
They thought the prices made perfect sense.
This is where my brain just breaks. And this is where we really need to challenge the premise. How do geniuses get so utterly blinded?
It's the multi-trillion-dollar question.
If they were looking at these astronomical valuations, what invisible force hijacked their logic?
Well, the invisible force wasn't a feeling. It wasn't some psychological momentum.
What was it?
It was cold, hard numbers. The smartest minds were slaughtered by their own so-called common sense.
The sheer scale of those numbers is staggering. Let's draw a really simple, terrifying line graph in your head. Just a line plotting the true inflation-adjusted value of Japanese stocks.
Okay.
Right next to it, plot the value of urban real estate in Japan's 6 biggest cities. The timeline is January 1985 to December 1989.
Just a 4-year window.
Right. Between those 2 dates, the real value of the stock market tripled.
And the value of urban land.
Tripled.
Yeah. It is just insane to think about.
3 times the value. In 48 months, you look at that and you literally want to scream, fake money.
Yeah.
You want to call it a scam.
But it wasn't fake.
Right, it was audited money.
Exactly. It was printed on the balance sheets of the largest corporations on Earth. People constantly ask me if this wealth was just pulled out of thin air.
Hey, it wasn't.
No, it was tethered to reality.
But a highly distorted version of reality, right?
Precisely. And to see that distortion, we can't just stare at the peak.
Right, you can't just look at 1989.
Exactly. The bomb wasn't planted in 1989. The avalanche was primed long before the party even started.
This is such a crucial point. Everyone focuses on the crazy peak. They look at the neon lights and the trillion-dollar valuations. They're looking in the wrong place.
Totally the wrong place.
The real trigger was pulled in the quiet years. Let's look at the data between 1982 and 1985. We see 2 diving lines on the chart.
Right, the dividend yield and the earnings yield. They plunged drastically.
Like off a cliff.
Yeah. Between 1982 and 1985, Japan's dividend yields were slashed in half. They dropped from an already low 1.5% to a microscopic 0.88%.
Okay, let's pause there for a second. Because for anyone listening who hasn't looked at a yield curve recently, 0.88% is practically a rounding error.
It's nothing. It is basically zero.
Yields were shockingly low before the so-called bubble even began.
Right.
It's like pouring gasoline all over the floor of your house in 1984 and then acting completely surprised when someone lights a match in 1989.
That is a perfect analogy. The market was already standing on the absolute edge of a cliff.
So explain that mechanism to me. Why does a low baseline yield make a market so fragile?
Because of hypersensitivity. Think of it like a lever.
Okay.
When your starting yield is, say, 5%, a tiny shift in the economy might move asset prices a little bit.
Like a normal market fluctuation.
Exactly. But when your starting yield is under 1%, even a microscopic change in the underlying economic math triggers a tidal wave in asset valuations.
So the market was starved for return. It was completely primed for an explosion.
Yes.
And that tiny change came. But it didn't come disguised as a warning, did it?
No, not at all. It came disguised as the best news possible.
The poison pill.
Exactly. Enter the new economy illusion. Imagine a chart showing real GDP growth and corporate dividend growth. From 1986 to 1989, those lines just shoot straight up.
So imagine you were sitting in an economy growing at over 6%. Corporate profits are surging. Would you call that a bubble?
No way. You would call it a golden age.
Right. It feels like you are winning.
You really have to understand the context here. Before 1974, Japan experienced miraculous astronomical growth. Then they hit a decade of stagnation.
The oil shocks and all that.
Right. So when growth suddenly spiked again in 1986, people genuinely believed the miracle had returned forever.
They thought a permanent new economy was born.
They took a short-term spike and extrapolated it to infinity.
This is the most brutal rule of the world, honestly. Prosperity is the ultimate camouflage for a massacre.
Oh, absolutely.
The good news literally poisoned them.
But here's the thing. A booming economy wasn't enough to cause a 300% spike in asset prices on its own.
They needed a catalyst.
Right. The math needed a spark.
The central bank.
Bingo. The Bank of Japan pulled the trigger. If you look at a stark data table comparing nominal and real interest rates from that time, you can draw a glowing red line under the drop from 1985 to 1986.
What happened?
In just 1 year, the long-term real interest rate was brutally chopped by 120 basis points.
Wait, hold on. Let me stop you right there. You are telling me a 1.2% drop in interest rates justifies a 300% spike in housing and stocks.
That's exactly what I'm saying.
That math does not check out to me. I mean, there has to be human irrationality baked into a multiplier that massive. Explain the exact math to me. Show me the mechanism.
Okay, let's break down the mechanism. There is a cold, ruthless mathematical formula underlying all asset prices.
The discount rate.
Exactly. The price of any asset, whether it's a stock, a piece of land, whatever, is essentially the present value of all the cash it will ever generate in the future.
Okay, basic finance 101.
Right. Now, to figure out what that future cash is worth today, you divide it by a discount rate, and that rate is heavily, heavily driven by interest rates.
Okay, so the interest rate is the denominator in the equation.
Yes. Now, remember what we established a few minutes ago.
That the baseline yields were already microscopic, less than 1%.
Exactly. When the denominator in a fraction is already tiny, and you make it even tinier, like when the Bank of Japan cuts rates by 1.2%, the resulting valuation doesn't just go up a little bit.
It explodes exponentially.
Because dividing by a fraction that is approaching zero shoots the total value toward infinity.
Wow. Okay, that is a terrifying realization. The machine was literally doing exactly what it was built to do.
It is mathematical destiny. It's not a psychological frenzy. It is capital blindly obeying a mathematical law. The formula demanded higher prices, so the market delivered them.
But wait. Mathematics assumes everyone agrees on the inputs.
Right.
The formula only works if everyone believes the new economy growth is actually permanent. What happens when the market develops a split personality?
That is when you get a bizarre asset hurricane.
A hurricane.
Yeah. Imagine two groups of people. One group is gloomy and silent. The other group is holding giant megaphones, just shouting about rising prices.
Okay, so here's a chilling truth about the economy. Prices are not decided by the average opinion, are they?
No, not at all. They are dictated entirely by the most aggressively optimistic people in the room.
That makes zero sense intuitively, but it's true.
When complex signals hit a market like vague, overly positive economic data opinions violently split.
A market with split personalities.
Exactly. Some investors look at the data and see an impending doom. Others look at the exact same data and see infinite wealth. This split in perception is the core of this whole deep dive.
Let's use an analogy for the listener. If 10 people are in a room bidding on a painting, the 9 people who think it's absolute trash don't matter.
They are irrelevant to the price.
Right. They don't set the price. The one person who thinks it's a lost masterpiece, the person willing to empty their entire bank account, that guy sets the price.
Precisely. The market becomes a forced celebration of optimism.
The market only listens to the loudest optimists. The asset prices reflect the highest bidder. But wait a minute. If there were pessimists who knew it was a bubble, why didn't they step in and crash the party? I mean, if I see a painting selling for $10 million and I know it's a fake, and I'm a financial professional, my instinct is to bet against it.
They didn't crash the party because the system literally outlawed pessimism.
Outlawed it.
Basically, yes. Look at a bar chart comparing short selling in the United States and short selling in Japan during this era.
Okay.
The United States bar is towering. The Japanese bar is a tiny, pitiful fraction, just 1/4 the size of the U.S. bar.
So why didn't the sober people fight back? Because their hands were tied behind their backs.
Japan had incredibly strict institutional limits on short selling.
Let's define the mechanics here for a second, just so we're all on the same page. Short selling is how you bet against a stock.
Right. You borrow a share, sell it at the high price, and hope to buy it back later at a lower price to return it.
Exactly. So if the buyers are the hot air pushing a balloon up into the stratosphere, the short sellers are the sandbags keeping it tethered to reality.
That is a great way to look at it. And Japan essentially mandated that you cut off all the sandbags.
Yeah.
They utilized strict uptick rules, which meant you could only short a stock if the price was already going up. You couldn't pile on and drive a falling price down.
Oh, wow.
Yeah. They also had strict bans on naked shorting, meaning you couldn't short a stock unless you had already explicitly secured the borrowed asset, which was really hard to do.
So the system actually strangled the truth.
Yes.
The pessimists had the intelligence to see the cliff approaching, but the system banned them from hitting the brakes.
When a system forbids negative bets, a bubble becomes a mathematical certainty.
Because the volume of short selling in Japan was completely suppressed.
Exactly. And when no one is allowed to bet against you, your confidence becomes absolute.
Which brings us to the peak of danger. And, the peak of danger is always the peak of confidence.
Always. Look at a survey graph peaking in 1989. If you draw a massive red circle on it, it highlights a terrifying statistic.
What is it?
Over 60% of Japanese institutional investors thought the market was perfectly priced.
Wait, 60%?
Over 60%.
This survey, and we're talking about the data from Schiller, Kanya, and Tsutsui, is the most reality-breaking piece of evidence we have in this deep dive.
It really is.
Let's dive into how this survey was conducted. Because these weren't random retail traders at home on their computers.
No, these were the institutions holding the actual levers of the Japanese economy.
And at the absolute peak of the frenzy, the vast majority were totally convinced prices were reasonable.
They weren't blinded by greed. That's the truly terrifying part.
They sincerely, genuinely believed the fundamental data supported the sky-high prices.
Yes. They predicted expected earnings growth at over 5% for a decade. They believed in their quantitative models.
The greatest danger doesn't announce itself with panic. It arrives with a calm, serene certainty that everything is fine.
They looked at their spreadsheets and said, the math checks out.
But while Tokyo was completely confident, across the ocean, alarms were blaring.
Oh, absolutely blaring.
Imagine 2 lines forming a giant X on a chart. The red line shows Americans panicking. The blue line shows the Japanese just relaxing.
This reveals the fatal blind spot of the insider. While Japan thought everything was totally fine, a staggering 75% of American institutional investors smelled death.
75%.
Yeah. They looked at the exact same Nikkei index and saw a catastrophic overvaluation.
So you have 2 groups of highly educated experts looking at the exact same sky, seeing 2 completely different realities.
A massive cognitive split.
Who is right? Is it the insider who knows the nuances of their own home? The person who walks the streets of Tokyo, who talks to the corporate boards, who feels the localized energy?
Or is it the cold, ruthless outsider who just sits in a skyscraper in New York and looks at the math?
Right. Who won that debate?
Well, the Americans started pulling their money out. They aggressively reduced their exposure. History wrote the bloody answer in the ledgers. The outsiders were right.
But here is where the psychology gets even darker. Even among those inside Japan who actually knew a crash was coming, A twisted game kept them playing.
Yeah, it is the dynamic of dancing on knives.
Let's look at a graphic breaking down the psychology of the aware gamblers. These were investors who explicitly admitted the market was wildly overvalued.
They knew it was a bubble.
They knew it would eventually crash, yet they stayed heavily invested. Why?
Because nearly 40% of them believed the prices would keep going up for just a little bit longer.
So they fully expected to make a profit the next year, even while knowing it was a bubble.
Exactly. It's the gambler's delusion. I won't be the last one holding the bag.
It's a massive multi-billion-dollar game of hot potato. But let's dig into the actual mechanics of why a fund manager does this.
It's about incentives.
Right. If you are managing a billion-dollar portfolio and your benchmark is still rising, you face immense career risk if you pull out early.
Huge risk. If you sell and the market goes up another 20%, you lose your job.
You look like an idiot to your clients.
Exactly. The institutional incentives force you to dance on the blade of a knife. Everyone thinks they're the smartest person in the room. Everyone thinks they can jump off a microsecond before the blade drops.
But the blade always drops. And when it does, it doesn't gracefully float down, it avalanches.
But why? Why do bubbles pop like balloons instead of deflating slowly?
That's a great question. Imagine a bell curve, but violently twisted, leaning heavily to the left.
A negative skew.
Right. This shows the negative skew of stock prices dropping fast and hard. Good news is already spent. Bad news is hiding in the shadows.
A crash is all about hidden information. Remember those pessimists we talked about earlier? The ones whose hands were tied by the short-selling bands.
The sandbags.
Right. They didn't just change their minds, they walked away. They took their negative information, their bearish analysis, and they vanished into silence.
Ah, the spiral of silence. It's like the dog that didn't bark.
Exactly. When the overly loud optimists finally get spooked, maybe a bad earnings report hits, or the central bank hints at a rate hike, prices start to slip.
And what do the optimists do?
They look around for buyers. They assume the value investors will buy the dip.
But the pessimists sitting on the sidelines don't jump in.
Why would they? They know it's not a dip. They know it's a cliff. They just watch it burn.
So a crash is really just a sudden, violent accounting of all the bad news that was forcefully hidden for years.
Yes. All that silenced pessimism suddenly hits the ledger at exactly the same moment.
And you can actually see this exact moment of realization on a chart. It looks like a heart monitor flatlining.
The death countdown of trading volume.
Yeah, let's layer stock prices over daily trading volume. In 1989, the volume is explosive. People are frantically swapping shares.
Buying and selling constantly.
But look at 1990. The moment the bubble pops, the volume line falls off a cliff.
In financial economics, we look at dynamic, heterogeneous agent models.
Let's avoid the jargon. What does that actually mean?
It means we look at how different groups of people disagree. And these models dictate an ironclad rule. Argument equals action.
Disagreement drives trading volume.
Exactly. When opinions are violently split, volume is insane.
Right. If I think a stock is going to the moon and you think it's going to zero, we trade.
But the moment everyone finally agrees that the market is crashing, the disagreement ends, the optimists finally see the truth, the pessimists are validated.
And no one wants to buy.
Silence.
That is the cruelest logic of the world. When consensus is finally reached, liquidity dies. You want to sell your Tokyo real estate. There is no buyer.
And without liquidity, your wealth is a ghost.
The day the money stops moving is the day of judgment.
It really is.
So what do we do with this terrifying realization?
We have to rebuild our cognition. We have to stop trusting the disguise of rationality.
Picture minimalist text over a blurry, chaotic photo of a financial street. A solid circle drawing a continuous loop around three concepts: data, disagreement, flawed rules.
We finally see the matrix. The lost 30 years of Japan was not a fever dream of human greed.
It wasn't just a casino.
No, it was a perfect, lethal storm. You had a short-term spike in good economic data. You had a violent split in opinions driven by microscopic yields.
And you had a broken trading system that silenced the warnings by mathematically banning pessimism.
The underlying code of every financial disaster is exactly the same.
We wrap our gambling in the respectable clothes of rational fundamentals. We build complex, mathematically sound spreadsheets to justify the madness.
But it's just math weaponized by flawed human perception.
Which brings us to the most uncomfortable question of all. Are we doing it again?
That is the question, isn't it?
Picture a pure white canvas. Dead center, a pitch black question mark. Faint, ghostly lines of modern data flowing beneath it. Everything is a cycle, and we are naturally blind to the current one.
When we look at the transfer of wealth, the unbreakable cycles of human nature, and the raw mechanics of capital, we see echoes.
The exact same variables that broke Japan are floating in the ether today.
You don't have to look hard to find them.
Look around you right now. We have a global tech frenzy driven by artificial intelligence narratives. We have constant obsessive speculation about central banks cutting interest rates.
The denominator effect again?
Yes. We have incredibly loud optimists dominating the timeline, while the skeptics are drowned out by the noise and the institutional momentum.
The pieces are rearranging on the board. The empire of capital is running the exact same algorithm.
The inputs change, but the core formula remains.
Absolutely.
So the question you have to ask yourself tonight is, when you look at the market today, are you the outsider smelling smoke? Or are you the insider, completely confident that the numbers make perfect sense? Keep diving deep.